Welcome to today's webinar, Automating Sales Tax Compliance Without the Headaches. My name is Gary Dehart and I am the host. Your presenter is Brad White. Brad's the CEO of Bark Solutions, and he will share his credentials after I turn this over to him.
Awesome. Thanks, Gary, and welcome everybody to the webinar. Thank you for joining. First off, I know you got busy days, you got lives, you got businesses, and so just taking some time out of your day to join us and learn a little bit more about sales tax, specifically automating sales tax. Just really appreciate you taking time out of your day to be here. I won't spend too much time on myself in terms of background, other than the fact that, hey, I've been working with QuickBooks for over 25 years. VARC Solutions is a QuickBooks solution provider. We help clients with all things QuickBooks. We're not a CPA firm. We don't do that, but everything else we pretty much do. We're also partners with Avalara. We do sales tax implementations. We do sales tax advisory. We do that kind of thing. And so that's why I'm here, really just to share some of the background and experience and expertise that we have with you, in the hopes that it'll help you do your jobs better, whether it's for your business or for clients that you're working with that might have sales tax challenges. So that's kind of the goal. If you do have questions, please do put them in the questions panel. And if we have time to answer them during the webinar, great. If not, we'll follow up after the webinar for sure. So let's just go ahead and get right into it. In terms of the agenda, what we're going to be talking about today, we're going to talk about why automate sales tax compliance. There's some challenges with sales tax. No matter how simple it might be in your business, it's still complicated. And so we're going to talk about that. Want to talk about the components of sales tax compliance, like what are the things that we have to get right. And that includes things like who you sell to, what you sell, where you sell it. And I've seen some webinars where they really get into like the legal decisions that have led up to this, and I'm not, you can Google those types of things. My goal is not to give you the legal history, but just to say, hey, as of right now, here's what we're dealing with, and here's how we can address that within our businesses. So I want to then put it all together in terms of how we can automate this process. And then at the end, really just give you some resources to help. Some of those are me, some of those are our company, but we also want to give you some resources that could be a benefit to you that don't even involve me. So that's the goal for the webinar, and I hope you get some value out of it. So let's go ahead and talk about why. Okay, why should we even be concerned about automating sales tax compliance? The summary of this entire slide is it's complicated. So sales tax is time consuming. It takes a lot of time and effort, especially if you're doing it manually. And that's just because every state does it differently. Every city within a state can do it differently. Every county or parish within a state can do it differently. And there's no one way to do everything. Every state has exceptions to the rule, variances from the rule. And so those things are just really, really challenging to manage so that we are in compliance. When I talk to clients about sales tax in general, I tend to go with the statement like, if in doubt, tax it. Whether that may not be 100% accurate in every case or not, but what the risk that we have to mitigate as a business is, did we undercharge tax? Did we not charge the right amount? And heaven forbid we ever get audited. Can we defend our decision? And more importantly, especially in growing businesses that have more and more sales tax liability, how can I not get in an audit situation stuck with a big bill that I never collected money on? Okay, so that's why I say, if it's in doubt, tax it, and that way you can always pay it if you do get audited. But let's talk about how to do it right. Okay, let's do it right. Let's get it exactly as possible, and not then worry about the audits, because we'll know that we've done it right. Okay, but point is, every state does it differently. Products and services are taxed differently. Who you're selling to makes it really, really challenging as well. So when we specifically talk about states, okay, not only do we have some states that don't even have a sales tax, most of them do, obviously, but the sales tax filing and reporting requirements are not cohesive. They're not consistent across different states. And so if I have a return, for one state, I might be just having to put in a gross sales for that state. I might have another one where I've got to break that down by county. We got another one where we might have to break it down into more detail, like what's the breakdown of exempt sales and why are those exempt? Point is, if I'm selling in 5 different states, I've got 5 states, they're probably completely different, and I might have to run different reports out of different systems to get all the information. Forget about logging into the sites and figuring out the forms too. I mean, that's hard enough. We have clients that lean on us to help them, get on those state websites and fill out the form correctly. We have clients that literally call us and they're like, I'm on the site, I just don't know what to do. It doesn't make sense to me. And quite frankly, states don't seem to want to make it super simple. Okay. So those are some of the reasons why I think you ought to look at automating sales tax. And then the question becomes, well, why don't I keep doing it manually? And it's really the flip side of the same question, which is, if I'm looking to grow a business and I'm looking to scale a business, I want to be as efficient as possible. If I'm doing things manually, if I'm having to um, try to figure out when things change using the tax notices that I get in the mail from a given state, that takes time. And quite frankly, I'm probably going to mess it up. And that's just me speaking on my own behalf, not on your behalf. It's like, it's hard and it's easy to make mistakes if things aren't systematic, automatic, happening automatically behind the scenes. And it's like, I've been in several businesses throughout my career, several of which have had sales tax audits, and those are never fun. Even if you're doing everything right, it's never fun. But being able to support what you're doing and why you're doing it and how you're doing it, especially if it's automated, can really massively save a lot of time and energy. So my bottom line for why not do it manually is it is about time savings. Sales tax is not a revenue generation part of our businesses. It is a cost. And so if there's anything that I can do to lower the time and cost associated with managing sales tax, that's ultimately going to help me grow my business more profitably and make everybody's lives on my staff a lot easier. So hopefully that same concept is true for you. So I'm about to put up the first poll, but just big picture, when we talk about getting this right and automating sales tax, there's really 3 key areas that we need to make as systematic as possible in terms of how we track and manage the data. And that is who you sell to. Okay. Are they taxable? Are they not taxable? What you sell. Okay. Is it taxable? Is it not taxable? Or there's variations? And then thirdly, where you sell. Okay. And again, I'm going to go into each one of these components more deeply here in a moment. But those are the overarching parts that we have to get right. So every part of that is complicated and there's exceptions to every rule. But let's go ahead and load up the first poll because I want to get a sense for you in terms of what parts of your sales tax compliance picture that you're most worried about. Okay, so go ahead and pull that slide up there first. So which aspects of sales tax compliance are you most worried about? There should be 4 answers to that question. Exemption certificate management, like who do we sell to and managing the exempt status, the taxability of different products and services, having Nexus in the states where you sell, or quite frankly, all the above. So we'll give you a few more seconds to answer that poll, and then we'll show you that. Okay, so the results are in, and this is great. So sounds like pretty consistently across the board, there's concerns about exemption management, the taxability of different products and services, and the nexus, and of course the by and large responses is all the above. And by the way, sometimes I'm kind of like leading a horse down a road, right? That's kind of expected, right? If you're not concerned about all 3, there's probably something that we need to be having a conversation about. but these are three areas that we should be worried about and making sure that we're doing right. So thank you for showing that poll results. Thank you for participating. And let's go ahead and move on. All right, so let's talk about the first component of sales taxes, and that is who you sell to. So it's no longer good enough to just say, okay, if they're in my state, I need to be worried about sales tax. And if they're out of my state, I don't need to be worried about that. That might have been true 10 years ago, might have been true 7 years ago. It's not true today. And again, there's all these, legal decisions and this, various state versus United States, whatever, those types of legal decisions which have impacted this. Not going to go into depth on that. Just know that there are legal precedents behind all of these things, and every state wants to go in and find more ways to tax people and get more revenue into their state. But at the core level, it is still a very common question: is this person that I'm selling to in my state? Are they out of state? Okay. When they're out of state, there's still reasons why that customer might be taxable. And we're going to talk about Nexus and all that stuff a little bit later in the webinar. But we also need to be concerned about, am I selling to an end consumer? Or am I selling potentially to someone who is going to take my product and then turn that into, resell that to their clients, whether that's a reseller, a wholesaler, a manufacturer, a distributor, or if this is a potentially exempt organization, which might be a state, local government, it might be a nonprofit, 501c3 nonprofit, or again, there's about 20 different reasons why somebody might not be taxable. And so we'll talk about that more. Okay, but here's the key. If I've got a customer that is potentially taxable, okay, or potentially not taxable, I need to be able to define when and why. Okay, so let's say I'm selling a product or service to a reseller. I need to be able to say that they're exempt from sales tax because they're a reseller. Okay, I need to be able to say, hey, this customer gave me their tax exempt certificate, and that's why they're not taxable, because they're a 501c3 nonprofit. It's not good enough to just say that they aren't taxable. We have to tell and track why. Back in the day, when I say back in the day, I'm talking about like 10, 15 years ago, we would have tax exempt certificates we stick in a file folder that went into a file cabinet, and we just collected in there. Well, that works to a point, but if you're ever audited, it's really, really hard to go through piles and piles of paperwork. So that's something we don't recommend today. Maybe a digital version of that, a digital version of a file folder. But there are tools and systems out there to help with that. Exemption certificate management as a concept is really what we're talking about specifically. And that is a way to automate the exemption management tracking so that you've got it on file. It's very easy to report on. I'm not having to dig through pieces of papers in filing cabinets. Okay. That is something that is really, really key. And again, you never need this until you're audited, and then you find out you need this. So part of the reason why we have this conversation on a webinar like this is to bring it to your awareness, to educate you on the fact that this is something that needs to be tracked and managed, not after the fact, trying to recreate multiple years worth of exemption history, but real time. As those things come in and as we start tracking sales for an exempt customer, we need to be tracking that now. Okay, so we'll talk a little bit more about that, but that's the key in terms of who you sell to. The second component is what you sell. And I wish this was simple. I really, really do. I wish it could be just like, when you sell this, it's taxable. When you sell this, it's non-taxable. And in a perfect world, that would be true. But unfortunately, we're not living in a perfect world. And as I mentioned, every state has variances here and exceptions here. So, but what I want to do is I want to also give you some general guidance. Okay. General guidance to keep you safer than you otherwise would be. First and foremost, tangible personal property. Okay. I'm selling a physical product that somebody's coming into my store and buying, or I'm shipping it, whether I'm shipping it or drop shipping it from a manufacturer. Either way, if I'm selling a tangible personal property, it is most likely taxable. In fact, I would say 97, 98% of the time, tangible personal property is taxable. Okay. And so just that would be my default answer. If somebody said, should I tax this? I'd say yes, absolutely. And until we get information otherwise that this specifically shouldn't be taxed for some reason. Okay. I think one of the other trends that we've seen in the last 10 years, of course, maybe even 15 years, is more digital products. I've got a software subscription product. I've got a cloud service that I'm offering my clients. I'm doing digital products. Okay, digital products and subscription products, regardless of how you deliver them, could be taxable. Sometimes they are, sometimes they're not. And so a lot of times, how and where you're selling that digital product, or how or where you're selling that tangible personal property, can impact the taxable status of it at a minimum, and the rate that is being charged on that as well. So the key here is there are going to be some categories that are going to be less taxable. Typically, labor is typically non-taxable, but again, the caveat there, the qualifier there is there are states that will charge tax on labor, and they may only do that in certain scenarios, right? They only might do that in certain scenarios when the service is paired with a tangible personal property, things like that. So part I want to do, and this is more just fun rather than anything. This next slide is not intended to educate you on all the variances that you might experience, but I want to use the next couple of slides to kind of dramatize the point that you might think you know how sales tax works, but I would almost guarantee you're probably not going to be right half the time. You could do a 50-50 coin flip on something and find out that you're wrong at least half the time when it comes to why something is or isn't taxable. And so I'm just going to give you a few examples on the next two slides. Some of these are just more classic categories of weirdness when it comes to states. But like in New York, tacos are tax exempt, but burritos are not. In Indiana, Snickers are taxable, while Kit Kat and Twix are not. Now, you may be wondering, like, huh? Why? It's like, what would cause a taco to be exempt or non-taxable and a burrito to be taxable? Okay. Well, if you do the research, what you're going to find is a lot of times states will define, and again, this is so silly to even have to talk about this. Some states will define burritos as a sandwich. Okay. In other words, there's a taxable category called sandwiches, and some states will categorize burritos as a sandwich, whereas they wouldn't categorize tacos as a sandwich. Okay. And so it's literally that behind the scenes categorization within a particular state that might determine if something is taxable or not. And if you've ever played that game, like, and again, now I'm going back into my history where, it's like we had a tax question and we didn't have Avalara, we didn't have all these services, and we just had to like call the state and say, should I be taxing this? Should I not be taxing this? And so in the old days when you had to call someone and get that type of answer, the proverbial wisdom in the day was call until you get the right answer, because you're probably going to get a different answer even from the same state agency if you call 5 different people. And so that just sort of reinforces the fact that this is a confusing thing. In New York specifically, the answer is clear on burritos. It is a sandwich and it will be taxable. Tacos, they may be, it's a little bit more open to interpretation. It's a little bit in that gray zone. Maybe it's a sandwich, maybe it's not a sandwich, but you see the point there. It can get really, really complicated. And so, for example, let's talk about Snickers versus Kit Kats. The core component, if you will, in that decision is, does that product have flour in it, or does it have a certain percentage of flour in it? Because a Snickers, since it doesn't have flour in it, it's considered candy, which is taxable. Okay. Whereas if you look at a Kit Kat and the Twix, it actually has the cracker in the middle, and that's made up of flour. And so when you get above a certain percent within a product, a state will make this, this decision from on high that this is a food product, not a candy product. And food products, again, more often than not, are not taxable, whereas candy typically is. So I use this as an example to point out some of the behind the scenes distinctions. Sandwiches are not sandwiches, flour, food products versus candy. Those are some of the root causes of some of those differences. But I wanted to show you a few more examples because, again, I think this is just kind of hilarious when you think about it. Different states, whether it's California, Texas, Indiana, Colorado, they have these weird rules, and these may only apply to a given state. But just as an example, donuts in Texas, okay? If I have under 5 or over 5, it's likely that if it's under 5, it's taxable, and if it's over 5, it's exempt. And by the way, it's not always because of the specific quantity, but in general, and again, I use that phrase a lot because I'm trying to give you a general overview and understanding without let's get into the details because there are so many different exceptions. But like, is this takeout? Okay, are you getting utensils with this thing that you're taking out? Because that can determine the tax status. Whereas if I have, let's just say, 5 or more donuts, it could be considered a grocery product or a versus a snack. Okay, because quite frankly, if you buy one donut, that's a snack. But if you buy a dozen donuts, that's obviously groceries, right? Those are the kind of weird distinctions we talk about. Bagels in New York, it's the same thing. If I buy a sliced bagel, that could be put into a sandwich, and so I might tax that. Whereas if I'm buying whole bagels, well, obviously that's more of a grocery item that I'm going to take home, okay, and just apparently eat without slicing it. Okay, so those are just some of the weird ones. So I'm not going to belabor the point any more than I already have, but just those are some of the behind the scenes reasons why things are weird, and there is no cookie cutter to do a pun because of the Reese's and the Kit Kats. There is no cookie cutter answer to when something is or isn't. So again, that is alluding to the fact that we need a solution here. We don't need to be making these decisions every single time we sell something. Okay. Okay. So what is the solution specifically to whether a specific thing is taxable or not, especially as it relates to a specific state? The answer to this is tax codes. Okay. In other words, there's all these different things that businesses will sell. I'm using on the slide right now, I've got an HVAC installation example, but just imagine out of the hundreds of different industries that any business might operate in the hundreds of different products or services that they may be providing to their clients, there are so many variances in terms of what that thing is or how you might describe it. And the good news is, as a business, I kind of just need to figure this thing out once. Okay. And unless I start selling drastically different things, I shouldn't have to figure this out over and over and over again. What I need to do is think about what I'm selling, how I'm typically selling it, like what is this, how would I typically describe this thing, and then come up with the right tax code so that the system can drive the taxable status based on the code, not based on what I'm typing into an invoice on a description line. Okay. Or the name that I happen to be calling this particular service or product that I'm selling. So just to give you an example, and I'm not going to make you read the screen, but I want to just sort of highlight why this is so weird and complicated, is if you look at HVAC installation, maintenance, and repair, some of the distinctions might be like, hey, am I installing a brand new air conditioning unit in a brand new building? And so that HVAC unit is becoming part of the commercial property or part of the commercial building. Okay. Well, that's different than if I'm going in and repairing an HVAC system or swapping out or replacing an HVAC system. But it goes beyond that. Again, let's also then talk about the states. So if you look at that table, The tax codes that I've just pulled out as a sampling are across the top, and the states going down that left sidebar. So even the same thing that has the same tax code based on the description of what I'm buying, what I'm selling, okay, is taxed differently in different states. Okay, you can see the first category, that PE 70212. Room, energy efficient equipment, room air conditioners, what have you. Okay, taxable in pretty much every state. Okay, not every state, but the ones that I've kind of pulled out, taxable. Some of these other ones, though, some it's taxable in some states, exempt in other states. So that's why I say it gets really, really hard to manage this manually, because again, trying to micromanage that on a per client, per sale basis is really, really challenging unless you do have a system that's automatically calculating that stuff. Okay. All right. So let's talk about the next challenge within this space of sales tax automation and compliance, and that is where you sell. Okay, so obviously there's this fancy word out there that you may or may not be familiar with. It's called Nexus. Okay, in a sense, Nexus really just means, have you put yourself in a position as a business where you need to be registering with the state, collecting sales tax, and then obviously remitting that sales tax to that state, either on a monthly, quarterly, or annual basis, depending on that state. Okay, Nexus basically says you need to do that. Okay, there's different types of Nexus. Okay, so let's talk about that. The most common type of Nexus that we're probably all familiar with, or at least we should be, and that's physical Nexus. I am a Texas company. I have a building in Texas. All my employees work in Texas. I have physical Nexus in Texas. Okay, that's been the way that concept has been around forever. It's true across the board. And in that scenario, I better be registered with the state of Texas. I better be collecting and remitting sales tax. What gets a little bit more complicated is when I don't have a physical presence in a particular state, but I am in fact doing business in other states. Question is, what does doing business in other states mean? Or how do I define that? And so states over the last, again, 10 years or so have defined another concept called economic nexus. So I might not have employees in a particular state. I might not have a physical building or headquarters in a particular state, but because of my sales to a particular state, I might have Nexus and I might need to register. I might need to start collecting sales tax. We're going to get a little bit more detail on that for sure. But generally what defines that is either a certain number of transactions per year in that state, or it's the volume dollar-wise of sales within that state. So even if I've got an e-commerce website, people are buying it online and I'm shipping it or drop shipping it to another state, those sales will count, okay, towards sales within a particular state. And at some level, you might be triggering economic nexus. And I wish this was, again, so super simple and easy to say that every state did it the same way, but the reality is all the states are different. They do it all differently. They have different thresholds, as we'll define here in a second. But that economic nexus is probably the biggest change that's happened in the last 10 years. It's more and more states are basically saying, yes, I know you're not physically here, but we're still going to make you charge sales tax. Okay. There's click-through nexus, there's affiliate nexus, there's marketplace nexus. I mean, this could be as something as simple as I have a data center that's hosting my data, and that happens to be in a different state than I physically am. Those are the types of triggers that they're not on the surface, they're not super, super clear, but those are the things when you get the letter in the mail from a particular state and said, we have determined that you have nexus in our state, you need to register, collect, and start paying sales tax. Okay, so hopefully hopefully none of you have received that type of letter in the mail, but that's what tends to happen because somebody will notice, somebody will see it, and that could be you're doing mailers to a particular state, you're sending flyers to a particular state, you're attending a trade show in a particular state. All those different reasons can be triggers for Nexus. Okay. So this slide just kind of gives you another perspective on that same concept, in that Obviously, if you have multiple locations of your business, you do operate, in fact, in multiple states. That is a common reason for that physical nexus. But you might have leased property, you might have real property in a particular state, you might have a data center, you might have field employees. So think of it like this. Let's say I'm in Texas, but I'm right on the border of Texas and Oklahoma, or I'm in California and I'm right on the border of California and Arizona or Vegas, Nevada, and I have reps, field reps that are going out and servicing a client in that other state. Field service type of charges to a client in a different state could be a trigger for that economic nexus that we also have to be aware of. Okay. I've had people, ask, well, I mean, I've got a distribution center, that's in a different state, but I'm not selling any products to a customer in that state. Even so, if you've got a distribution center, a warehouse, that could trigger the physical nexus rules, and you might have to be registered in that state. Okay. Doesn't mean you're going to have a lot of sales tax liability there, but it's another reason why states might be triggering that for you. Okay. Okay, so let's give a little bit of background here. And again, legal reasons why this is true, but 2018 and older, there was very few states that were leaning into economic nexus, which means back then it was a little bit more cut and dried. I could probably in many cases say I don't have nexus because I'm not physically there. Okay. However, what happened is obviously legal battles ensue. Somebody wins a case that says it doesn't matter if you have physical nexus or not, you are subject to tax. And once that happened with one state, other states that, by the way, said, ooh, I could use this to get more tax revenue to my state. We're going to adopt the same type of rules. And here we are, 6 years later, 8 years later, and now almost every state has an economic nexus rule. And the whole goal is just state revenue. I mean, that's the bottom line. So it is what it is. Okay, so let's talk about some of those thresholds, and then we'll have one more poll question to load up, and I want to get your feedback on as well. What this slide is intending to highlight is that different states have different thresholds. So you can see some states you have to have $500,000 worth of actual sales within that state to trigger nexus. Some of states it's 250,000. Some of them it's as low as 100,000. There are some states which combine a sales dollar amount trigger with a transaction count or volume component. So, for example, Connecticut, you have to have $100,000 of sales and 200 retail transactions for you to qualify with the Nexus. Other states, it's just sales. Doesn't matter if you have that in one sale or 10 sales or 2,000 sales. Once you trigger that sales volume, you might be subject to that Nexus and required to register, collect, and then file and pay. So as you can see, every state's different. If you're doing any decent volume of any decent volume of sales in another state that you don't physically reside in, you can look at this type of map. Avalara's got it on its website as well. If you type in like Avalara Nexus sales thresholds, you can find this same chart. It's on their site. But bottom line is if you go run a sales by state out of your accounting system or ERP system, look at anything above $100,000, just start looking at that, because that could be something that you would require Nexus to register. Okay. All right. So let's go to the next poll question. If you can load up that poll question, is like, how do you feel about your specific Nexus exposure? Are you confident that you're registered and collecting all the right states? Are you not sure if you're registered and collecting in the right states? Or worst case scenario, are you worried that you're probably not registered and collecting in all the right states? And by the way, this is very anonymous. This data isn't being shared with any states, so don't worry about it. I just want your honest answer. Are you confident? Are you not sure? Are you worried? Okay. Give you a few more seconds to make your answers, and then feel free and show those results when there's enough people that have responded. Okay, very good, very good. All right, so we have about 27% of you that are confident. We've got 73% that are not sure, and we have nobody, which is truly worried that you're not registered and collecting. All right, so I'll take that for what it is. Appreciate your responses. So let's focus on the 73%. So you're not quite sure. And by the way, that's a very legitimate place to be. I would say when it comes to sales tax, that's probably the place that most people should be, right? It's very hard to definitively say, I'm good. Okay. So if you're at all not sure, 73% of you, the good news is, again, at the end, I'm going to share some resources for you so that you can be sure, so that you can go from not sure to 100% confident. So that is a takeaway from this webinar that I want you to get. Okay. But I appreciate your honesty and your feedback. All right. Let's go to the next slide. Okay. So let's talk about some of some of the parts of this whole automation process that we need to make sure that we have nailed down. And also some of the reasons, again, why this may be hard, okay, especially if you're trying to do it manually. A lot of accounting systems out there. And by the way, I'm including QuickBooks in this, whether it's QuickBooks Desktop, QuickBooks Online, but it includes other accounting systems. Whether you're using Microsoft Dynamics, if you're using NetSuite, if you're using Acumatica or any of these other Sage products, there's going to be some level of sales tax capability within those tools that's going to either do it more accurately or less accurately than others. But one of the things that I want to draw to your attention is if you're relying on a zip code to inform you whether or not something is taxable at a certain rate or non-taxable at another rate, I'd say it's good, it's close, but it won't be 100% accurate in all cases. Okay. And I'm going to give you a couple examples of what I mean by that, and I'm going to dramatize that for you. But here's the key. And this is why we talk about this, because I want you to be aware of it. If you're just assuming that it's right because you've got the right zip code and you think in that zip code, here's the tax rate, that may generally be true, but there's going to be some variances there. Because even within the same zip code, you might have different cities, you might have different counties. And since counties and cities tax things differently, okay, in many cases, zip code is not good enough, okay? Because I have, a city could add a tax, they could have a municipality tax, there could be some sort of other tax or like truly an other tax that they tack on that right next door might not tack on. So that can be a challenge. What I try to tell people when I talk to clients about this is zip codes are okay. They're good, but they're not great. It's kind of a blunt instrument. It's kind of a very, very generic way of saying, I think I know this is right. Okay. However, if you want to make sure that it's 100% accurate, you can't rely strictly on it's this state, it's this zip code. Okay. So I think what a lot of clients do is they get into a false sense of security because they feel like they did the research once and they think they got the right tax rates. But since things do change over time, and it's really, really hard to keep up with all those changes manually, it is oftentimes you look 5 years later and you find out you've been doing it wrong. Okay. So I'm going to give you a few slides just to kind of give you some examples. And so, for example, same city, different county. Okay. Same city, different county, same zip code could be charged differently. Okay. The example that I've got on the screen there is I've got an address that's in Friendswood, Texas, 77546. But since that zip code actually has different counties, okay, within that zip code, in one place within that city, I might be charging 6.75%. In another part of that same zip code, I might be charging 8.25%. Okay. Here's another example. Commerce City, Colorado, 80022 zip code. Okay. Same city, same zip code, same street, literally same street within that city and zip code could be charged drastically different. If you've ever heard of like gerrymandering for, political, voting and that kind of stuff, the same kind of thing happens in a local level. There may be reasons within a particular city that the city council, whoever is the taxing jurisdiction within that city might say, ooh, within this zone, it's taxed at one rate, and with this other zone, it's taxed at a different rate. Cities like to offer incentives for companies to come in and they do some things, but that's unfortunately more common than you might think. But again, reinforcing this concept that if you think you know it right, you think it's right just because it's in the same zip code, you may be wrong. Okay. So is QuickBooks enough? Again, I'm a big fan of QuickBooks. We use QuickBooks every day. We have clients that use that and we consult on that every single day. For accounting, I think it's amazing. It does a lot of good stuff. Okay. But from a sales tax perspective, is QuickBooks enough? And I would say the answer is no, it's not. Because in a large sense, even though I think have been some improvements over the last couple of years, especially in QuickBooks Online, it is still a little bit of a blunt instrument when it comes to calculating sales tax. And just to give you an example, I took a specific customer that was taxable, a specific product that was taxable, and I fed it into the QuickBooks engine and the Avalara engine, and the results were different. Same customer, same physical address, same product. QuickBooks calculated that as $247.50 of tax. Avalara said, no, it's $202.50, because Avalara has that GPS level accuracy down to the pin drop versus QuickBooks that might be more zip code based. Okay. So just again, show you the fact that there are differences between different accounting systems and or between different services like QuickBooks versus Avalara. Okay. So let's talk about the process. Like, how do we automate the process of sales tax? Like, how do we make sure that this is getting right? So this is obviously what we were really building up to throughout this webinar. And so with Avalara as a service, and if, by the way, if you've never heard of Avalara, they've been around for a long time. They're a very, very large company. And one of the things that they do really, really well is tax calculations, filing, returns, etc. Okay. And so how do we automate? So if we use Avalara as the use case here, instead of having our accounting system, such as QuickBooks, calculate the tax and then have us run the reports and log into the states and file the taxes and do all that manual filing, we can have Avalara automate that. So what does that look like? Okay. The way it looks like at a high level is, within your accounting system, you're going to record your sale just like normal. Okay. But if you're using Avalara and you've integrated that accounting system with Avalara's cloud service, this is how it's going to work. Avalara is going to take over the calculation of that of the sales taxes on that sale. They're going to return that sales tax amount to your accounting system, so that when you create that invoice and you maybe email a PDF of that invoice, it's going to have the right tax on it. So you send that sale to Avalara, again, magically behind the scenes, it magically comes back, it populates the sales tax, and now you're on with your day. At the end of the month, there's typically an approval process. So you're logging into the Avalara console. It'll have all the transactions in there. It's also going to summarize the sales and tax liability by state that you've registered in. And it's going to say, this state you owe this, this state you owe this. In this state that you're filing quarterly, it's accruing those taxes. Okay, so at the end of the quarter, that's when it's going to say it's due. But the good news is, you're not just blindly assuming everything's right. You do have a step that you can go through to approve those sales and those sales tax liabilities. After you approve it, Avalara, on a very, very consistent schedule every single month, is going to draft the amount that you've approved out of your bank account. They're going to use those funds to then file the returns and pay the taxes to those states. And the other thing that I lean on pretty heavily is the sales tax notices. Every once in a while, right, you're going to get a notice from a state that said, hey, you failed to file a return, or you didn't, maybe you filed the wrong, and again, I'm assuming, let's say for a second that you're doing this manually. Okay. You might get a notice from a state saying, hey, you paid late, or you remitted the wrong amount. Okay. When you're using a service like Avalara, you can also take those sales tax notices, send them to Avalara, because they're on the hook for making sure that it gets done right and on time, as long as you approved it on time, and they will then handle the notices. And I've gotten into those scenarios where I'm getting literally notice after notice after notice, month after month after month. It is frustrating as heck. I can just pass those over to Avalara and say, can you guys deal with this, please? That'd be great. So the key here is you need to understand where your business must register and collect tax. Okay. Again, Avalara has a service that can help with this, and I'll talk about that. You can then register within those states that you do have Nexus in. Avalara can then help you calculate and collect the right amount of tax, tracking when you have an exempt sale, when it's a normal sale, and then obviously remitting the sales tax, filing those returns. And that's what Avalara can help you automate through this process. Okay, so again, let's pull up the last poll for the webinar. And because I want to know what part of the sales tax compliance do you feel like you might need the most help with? Okay, so the poll's up there. Take a few moments to answer that question. But the question might be, especially for those of you that were like, I'm not quite sure if I'm doing this right. Where do you feel like you need the most help with? Is it in that sales tax nexus area where you might want to assess your risk? Are you worried about the sales tax calculations themselves being right? Are you needing the help with getting registered in those different states? I'm going to leave that poll up for a few more minutes and talk about one more thing while we're at it. A not so common occurrence, but it does happen every once in a while, is, you've been doing business for 10 years. You find out that you've got Nexus in a particular state, and maybe you should have been filing returns for the last 3 years. Okay. Maybe the last 5 years. So there is in the sales tax world, there's also a thing called amnesty. Okay. Where I can go basically to a state and say, I'm sorry, I know we should have been doing this. Please don't penalize us to the point where we, are really, really hurting as a business. So there's an amnesty program that relates to all this. And that is involved in the process of registering, filing, and remitting in the right states. Okay. And then finally, the last thing on this was exempt certificate management. So go ahead and answer that. You probably have already had time. So let's go ahead and show the results and see what we got. Okay, perfect. So 29% of you, a sales tax risk assessment might be helpful. 21% of you making sure that you've got accurate sales tax calculations. 36%, a little bit surprising, but also not surprising, in that states don't make it easy to register. They don't make it, like, where do I go? How do I fill out this thing? What check boxes do I do that doesn't make it worse, right? Registering and filing and remitting taxes in multiple states, 36%. Okay. Again, appreciate the responses. The good news is there are solutions for every one of those things, and we can help with that. And again, I'm going to give you some resources as we get to the end of the webinar. All right, perfect. Okay. So as we get to the end of this webinar, I want to give you some resources, okay, to help. So, I'm fair game. Our goal as a company is to help, right? And sometimes that's helping clients. Sometimes that's, being more of just a friend and an advisor to somebody who's got a question. Feel free to reach out to us. VARC Solutions, we are a certified Avalara AvaTax implementation partner. So not only can we refer clients to Avalara, but we can also actually do the implementations of that within different ERP systems. But Avalara does have some tax research tools and support, and I'm going to touch on one of those on the next slide. But again, just here's some resources that I think could be helpful to you. Get your phones out. If you don't have your phone out, get it out real quick and take a snapshot of these, save it for later. So a couple free resources. So first off is a sales tax risk assessment. For those of you that said I might need some help in terms of a risk assessment, there are free versions out there that are very what I would call minimalistic. It's just looking at very, very simple things. Tell me what your sales are for that state, how many transactions, and let's tell you if you have Nexus. And those are out there. Avalara has a quote unquote free one that's very, very scaled back and minimal. The QR code that I've got on the screen there for the free sales tax risk assessment. This is the comprehensive risk assessment that we're also providing to you for free. It's literally a $4,500 cost if you wanted to go out and buy that without the QR code. So please take advantage of that. It's a very, very good risk assessment, very comprehensive, but again, free if you use that QR code. And then secondly, obviously, if you wanted to have a demo of the Avalara system and kind of peel back the layer and see behind the scenes how this is working, we are happy to show you one-on-one. But I'd encourage you to use the QR code. It'll actually take you straight to the Avalara website where you can schedule a demo. And we'll be part of that conversation if you would like us to be. And if not, that's totally fine too. But bottom line, get a little bit of a demo on the software and see how it works and just see if it'll work for you. One of the common questions that we get is, will it work with my accounting system? Will it work with my website? Will it work with my ERP system? And the answer almost 99% of the time is absolutely yes, it will. Because Avalara literally integrates with thousands, like over 1,000 different systems. They also have API integration. So even if there's not something like within your software that says it will connect, through API integration, you can pretty much connect it with almost anything. Okay. So take a screenshot of those. Feel free to use those. And my contact information is coming up here in the next couple of slides. So you can always reach out to me too, specifically if you're not sure on what route you should take. Last couple just slides, just big picture on us and how we could help you. We've been in business since 1999. So for over 25 years, we've been in business. We've got a 17-person team. We focus on QuickBooks. We focus on Avalara as one of the partners that we work with. We also do bookkeeping. We do cleanups. We do migrations from other systems to QuickBooks. So we can help you. But again, we try to pride ourselves on being QuickBooks experts as well as Avalara and sales tax experts. Okay. We have clients nationwide. We primarily work with small to medium-sized companies. Doesn't matter what industry. If you're using QuickBooks as a general rule, we work with you. And we also work with desktop QuickBooks and online QuickBooks. A lot of companies these days are only focused on QBO. We work with desktop and online. We love them both and we use them both, and we encourage our clients to use them both when it's the right fit. Okay. Our phone number's on there. Our email address is on there. So sales@varksolutions.com, 281-412-6914. Feel free to give us a call and chat. Last thing I'm going to show you before we just open it up for any other questions, if we have time, and that is our solutions and consulting team. Again, I'm here. My name is Brad. I've got a guy on my team. His name is Adam. Love to have a conversation with you and see if we can help. That is the conclusion of the webinar. I hope this was helpful. I hope you learned something along the way. And again, let us know if you have any questions. And if we don't have time before the end of the webinar, we'll get to those questions and make sure they get answered. And Gary, if you're still there behind the scenes, let me know if there's anything else we need to do before we wrap up.
I am here. Just looking to see Q&A or anything. I think we're good to go. And
Awesome.
as we said, we'll send those resources out. And if you have any questions, you can reach out to Brad directly or hit us up at info@insightfulaccountant.com.
Awesome. Well, real quick, Gary, I know one of the questions we almost get every time we do a webinar is, am I going to get the recording? Am I going to get the slides? So how do you guys typically answer that?
Yes, absolutely. We'll send it in a link that you'll get within typically a few hours, and it'll have a link to a box folder that has the presentation. We'll have a link to our YouTube channel, which is where this will get posted. Typically, within about 24 hours, we'll get the recording posted to our YouTube channel.
Okay, perfect. Thanks, Gary.
All right.
Thanks everybody for coming.
All right. We'll see you in Orlando in a couple of weeks, Brad.
We'll see you there.
All right. Safe travels.
Bye.
All right. Bye.